Good morning, everyone. Welcome to our daily market outlook. Today's Friday, 5th of October 2012. Another day for the markets following yesterday's central bank's meetings. Of course, today is the US day with the non-farm payrolls and unemployment data being key releases of today, and all focus and all eyes of investors are turned towards there. Just to go back a bit to yesterday's decisions, both central banks, Bank of England and the European Central Bank, left their rates unchanged as widely expected. And also the comment from Mario Draghi, ECB's president, who did not say anything new, but gave some more boost to the single currency as they repeated the bond buying from Spain and the delay in bailout for Spain that is likely to be requested by Spanish officials sometime after the middle of month, where after the elections in one of the provinces in Spain, with Germany, of course, delaying things and saying that we mentioned yesterday actually that Spain basically doesn't need the bailout, but anyway, delaying it for a while. Giving some boost now to the single currency as positive sentiment and risk on established yesterday pushed the pair finally through the near-term range top at 129.75, and of course regaining a very important 130 barrier with yesterday's close above this level, seeing now more potential towards the upside. From overnight, Bank of Japan, as expected, stayed pat with the rates, keeping them at record lows, keeping basically powder dry as recession looms, and waiting some other opportunities to act. The Bank of Japan has resisted political pressure for action and kept its monetary policy steady, but left the door open to more monetary easing later this month by striking a pessimistic note on the state of the world's third largest economy, despite mounting signs that sagging exports to China and Europe may nudge Japan into recession. Central bankers preferred to wait and assess the effect of stimulus unveiled just last month and save their limited options for now. Underscoring heightening pressure from the government, newly appointed economics minister, vocal advocate of aggressive monetary expansion, made a rare appearance at today's meeting to make a direct call for bolder action. He said, "I'd like to continue urging the BOE to pursue powerful monetary easing to achieve its price target." He became the first economic minister to do so in nearly a decade. After Japan, as the dollar came under pressure from yesterday against Japanese yen, and some technical elements are now more pointing towards the downside. Of course, we're going to elaborate this more in our technical part. The dollar remains under pressure, and the strengthening yen is now threatening a return down below 78, very important support, loss of which would be quite bearish for the pair, and will signal the end of, actually will signal the losing ground again following a recent steady rally in past couple of days that reached 78.71. From America, as we said, the key release today is US non-farm payrolls, and fears are still present as expectations see not much a prospect for some more significant improvements in the labor market of United States, with today's quite weak expectations slightly above the previous very disappointing 96,000 in the previous month, seeing not much potential for some, as said, more significant release. The fears of government austerity likely will keep U.S. job gains modest and unemployment rate elevated in September, and this could be an outcome that could weigh on President Barack Obama's re-election bid. As said, the employers are expected to have added approximately 130,000 jobs to their payrolls last month, and that's slightly above from 96,000 in August, but it will still fall short of what is needed to cut the jobless rate. Economists expect the unemployment rate, a key focus in the race for the White House, to tick up by a tenth of a percentage point to 8.2% as Americans come back into the labor force to resume the hunt for work. The Labor Department's closely watched report, which will be released at 12:30 GMT today, will be the second last before the November 6th elections that pits Obama against Republican Mitt Romney. If economists are on the mark, it would present a seventh straight month of lackluster job growth. So basically, whole focus today is on U.S. data that are due set at 12:30 GMT. Among the other releases for today, we're going to take a look at our calendar. Okay, I think we're here. As said, European final GDP is due at 9 o'clock GMT, no change at minus 0.2%. German factory orders are expected to dip by 0.4% compared to 0.5% in the previous month. And then a bunch of data coming from America, starting with Canada's building permits expected to significantly improve at 1.4% compared to minus 2.3% in the previous month. Canadian employment change is expected to decrease to 15.3 thousand new jobs compared to 34.3 thousand in the previous week, and unemployment previous month, I do apologize, and the employment rate pardon, to stay unchanged at 7.3%. As said, the US non-farm payrolls according to the various forecasts, 113,000 is the forecast for today compared to 96,000 of month of August, and unemployment rate is expected to tick to 8.2% compared to 8.1% in the month of August. Average hourly earnings are expected slightly to improve 0.2% compared to unchanged the previous one, and that basically would be all for today's data. Consumer credit from US is due late in the afternoon, 1900 GMT, 7.5 million in plus compared to minus 3.3 billion in the previous month, with the FOMC member Duke due to have speech at before this at 5 o'clock p.m. GMT time. And that's all. Basically, we are all focusing the release of US data at 12:30 GMT, and this will be the key release for today. And not to waste our time, we're going to now take a look in the technicals and see quite interesting moments seen compared to yesterday's trading, where Euro as our first candidate jumps higher above the recent range top at 129.75, also breaks above 130.00. Yesterday's close above 130.00 occurred at approximately 130.14, peaked at 130.30. That marks, I do apologize, let's use this chart on 1 hour, marks exactly 61.8% retracement of the current corrective phase of 131.70 to 128.00, where gains were capped for now, and they initially consolidated in the narrow range during the Asian session followed, with some more corrective action expected to be seen during the European hours as the price broke below 130.10 and actually now is attempting below 130.00 as initial support, with the RSI now moving towards the downside, also MACD, and losing momentum on the hourly chart, seeing potential for some more corrective action towards the downside. Initial support, as said, has been cracked at 130.00, with the next one seen at 129.75. This is the previous range top and the previous resistance now acting as support, while extension below 129.75 should be ideally contained somewhere above 120, around 129, 40, 50 area, where we have, I'm trying to adjust this Fibonacci, I do apologize for this playing around 129, 40, 50 zone, where we have the 38.2% Fibonacci of the entire move from 128 to 130.30. Also, we have the trend line support, bull trend line of 128.00 through 128.76 and 129 as quite a good support, and basically any dip below 129.75 should be ideally contained around this area in order to keep near-term bulls in play for possible further extension higher. As for our studies are more positive at this point, MACD broke above the midline. However, RSI is now pointing lower. It's already below its 7 days moving average. Seeing potential for some more corrective action preceding a fresh rally. Ideally, another close above 130, or in case of a break higher, where we have 130.47 swing high of 21st of September close above this level would be quite give more credentials to the recent rally and open the focus towards the upside. Our key barrier double top at 131.70. Conversely, loss of 129.40, 50 zone, and more important 129.00 figure support and psychological support would bring bears back in control fully and turn again focus towards the downside. That will be increasing risk of lower top at 130.30 and open way for some stronger corrective action of larger correction of a larger up move from 120.42 to 131.70. Of course, most of the power now lies in the US data, which are according to the forecasts and the wide expectations, not going to be something very spectacular. And I expected quite weak that we will actually, I don't want to speculate now about this, but most likely sharing the opinion of a number of analysts, the data should not be very positive today. Of course, nothing is excluded, but according to some comments and opinions that I read this morning and yesterday, most likely scenario would be another release of quite disappointing figures of US jobs data. From the other instruments, sterling against dollar regained the ground on the break above important 161.75, 161.85 barrier. This was the previous range on the bounce from 160.66 fresh low posted 2 days ago. This is the gains so far reached 162.00. This is psychological resistance with the current consolidation being underway, but hourly studies our indicators started to point lower. That will allow for most likely some stronger corrective action, as initial support at 160, 180 has been lost. This was the area overnight range. Floor has been lost now, and most likely we might see some a stronger pullback preceding a fresh rally. 23.6% Fibonacci retracement is initial support, 160, 168, with the 161, 50, 38.2 reinforced by 55 days moving average that is starting now to move sideways from its up move, seen as the next quite good support, and basically any reversal within 161.30 and 161.50, 38 and 50% retracement would be quite good for the pair, as the near-term bulls would likely stay in play for a possible further extension higher, where we have the next targets above 162 initially is 61.8% retracement of 163.08 to 160.66 at 162.16, as I said, and then we have the trend line resistance, tentative bear trend line of 163.08 through 162.71, currently at 162.33. Basically, break above these levels would give more credibility to the recent rally, and possibly to focus our first of the key barriers, double top at 162.70. That will allow fresh attack towards stronger 163 resistance zone. Otherwise, any failure under 162.70 would see increased risk of lower top and fresh extension of near-term corrective phase of 163.08. Daily structure remains in the descending. Daily studies remain in descending mode on the current corrective action of 163.08, as a loss of momentum could be a signal for some a stronger corrective action. So far, 23.6 only has been retraced of the initial entire move from 152.67 to 163.08. As break below 160.66 would be a trigger for some stronger recovery. Of course, we have to see the today's behavior. Any loss of 161, I would say, is a important support will be bearish and turn focus down towards 166 and further. On conversely, regain of 162 and break above 162 requires break above 162.16, 162.33 in order to refocus double top at 162.70 and then the key barrier at 163.08 at 21st of September peak of the sterling. As I said, still a positive tone dominates on the near-term studies, and the current consolidative corrective action is seen likely preceding a fresh rally, but we have to watch on the downside. Break below 161.30, I would say it will be more risky, while below 161 will definitely confirm that corrective phase of 160.66 is likely over, and more focus will be turned towards the downside. Dollar yen, after rally from 77.42 after peaking at 78.71 yesterday, is now in the descending mode with the formation of failure swing and fresh extension lower down to 78.26 so far, where the temporary base was found. Sees increased risk towards the downside with the hourly studies already in the negative territory. More risk seen on a break below 78.26. That will open 78.10 and 78.00 our break point. A loss of 78 would be quite bearish for the pair, as this also marks approximately 78. This is the low of 2nd of October 2012, and basically loss of this support would be quite risky for the pair. So far, as shown on the 4-hour chart, the 20 days exponential moving average holds the downside ahead of the 55 days one at 78.16, and if we see the break below these levels, then could be quite risky and could signal the end of the near-term corrective phase from 77.42. As said, the negative tone that dominates on the hourly and the 4-hour indicators already descending lower of overbought zone could be a trigger for some stronger corrective action. In case 78 zone fails to contain dips, then we'll be talking about further weakening of the tone. Otherwise, any reversal above this level could still keep the near-term bulls in play, with the break above recent high at 78.71 required to turn focus towards more significant 79.00, 79.21, the peak of 19th of September, and of course the 200 days moving average at 79.31. And the dollar Swiss lost ground following upside rejection at 94.00, failure to regain 94.00 with acceleration seen on a break below 93.50 and then 93.30. This is the higher base. We have 3 attempts lower at this zone with fresh dips seeing extension slightly below 93 as a psychological support. 92, 93 seen so far. This was late yesterday's low ahead of current corrective bounce as that was triggered by oversold conditions on the hourly chart. The hourly studies are slightly regaining ground, but I wouldn't say that something spectacular could be expected unless we see regain of minimum 93.30 as a previous good support, while only break above 94 would improve the near-term structure and turn the focus higher as a part of the broader correction from 92.37 that so far peaked at 94.36 with the retracement levels so far seen over I do apologize. Retracement of the latest rally so far hitting nearly 76.4% of 92.37 to 94.36, seeing now more focus towards the downside as important supports have been lost, especially the 93.30 base and the 93.00 close to 61.8% retracement, as well as psychological support. Currently, if we don't see strong rally above 93.30 on the current corrective bounce, I wouldn't expect something more spectacular unless 94.00 is regained. Otherwise, likely scenario would be lower top and the fresh extension lower, as the studies on the 4-hour chart are also in the negative territory. Price holds below the moving averages with the bearish moving average crossover 20 over 55 days. Once with the 20 days at 93.45 and the 55 days at 93.58, offering another good resistance for the pair. So 93.30, 93.45, 60, and then 94.00 required to be cleared in order to improve the current structure, as the pair basically broke below the 93.30 near-term consolidative range, defined by on the downside 93.30, on the upside approximately 94.36 as the highest level. Break below these levels now weakens the structure and sees more potential towards the downside. As said, unless we see break above minimum 93.30, more focus seen towards the downside, and the break below 92.93 opens 92.83 and series of minor levels at 92.56 ahead of our key near-term support at 92.37. This is so far the lowest since reversal from 99.70 start, and then marks approximately 78.4% retracement, approximately close to there, of the rally from 0.9041 to 99.70, with more focus seen on the downside as 200 days moving average so far caps the upside, and the price breaks below the ascending bull trend line, connecting lows at 89.29 and 90.00 and then 90.41. So more focus seen in the near term for dollar Swiss towards the downside, unless we see the break above 93.30, 93.60, I would say, in order to prevent pair from further sliding. But any reversal under 94 would be just seen as a lower top for now. Let's take a look at crude oil. It remains under pressure following a recent fresh extension lower to 87.69 2 days ago, with the quick recovery still unable to regain important barriers on the upside, 93.30 and then 93.80 levels. 91.81 seen so far, still short of these levels, with 55 days exponential moving average keeping the upside limited for now, and the indicators on 4-hour chart being in the negative territory, seeing still more potential towards the downside. Overextended hourlies have already triggered some easing of 91.81 high of last evening to low at to reach low at 91.15 so far, just ahead of 20 days exponential moving average currently at 90.81. Bullish crossover of 20 over 55 days exponential moving averages sees some boost for the price here. Holding above 91, I would say, would be quite supportive, although according to the indicators not much to be seen at this point, as 4-hour ones are still holding below, but why not to say, in case of any reversal above 91, we might still see a potential for some reversal, although I don't believe much in these things. Stochastic is basically now trying to point lower. Momentum is slightly ascending, and the MACD is still below the midline but pointing higher, giving us some credibility to say that possibility of a fresh extension higher is not ruled out, especially in case of further weakness of US dollar. That might be good support for the crude oil. As said, the break above 91.81.92 required to open next significant barriers at 93.30 and 93.80, a break of which to bring us into more safe territory and open way for the further extension. Above this also we have 94.00 as the previous range floor and 94.20, 50% retracement. Break above these levels, as I said, could be quite supportive and provide actually the temporary relief for the oil price and prevent it from further slide. Otherwise, anything below these levels could be seen as a lower top and a fresh extension lower as a negative tone that dominates on the larger picture on the daily chart. Despite breaking above again 90 days moving average, still seeing more potential towards the downside, unless the levels I mentioned previously, especially the focus at 93.80 and 94.00 are regained. Above this again we have 96.12 200 days moving average. More focus still seen towards the downside in the near term for the crude oil. And the gold remains well supported, especially after yesterday's fresh weakness of the US dollar that boosted the yellow metal to the fresh 2002 high at 1795.70 seen basically this morning in the early hours of today. Previous highs were around 1795 seen yesterday. Yellow metal now remains well supported after breaking above 3 days range. Recent fresh high was posted on Monday at 1791, and now succession of higher highs and higher lows is attempting to define the uptrend of the recent low at 1736 that we can say already has been established, but we need to see break above next very significant barrier and psychological resistance at 1802. These are the highs of November 2011 in order to confirm the bullish stance and the open way towards record highs at 1920 of September last year. As I mentioned yesterday, a number of analysts already speculating with the $2,000 per ounce, so why not say the gold remains for now well supported, and especially in case of further weakness of US dollar today, we might see the clear break above 1800 and heading towards 1920. Immediate supports are the previous highs, 1791 already been dented, and then another tops at approximately 1780 zone, and then lows at 1770, 1763 seen as important levels. Break below 1760 50 zone, I would say it would be quite risky. We are still far from these levels, but we have to put the focus on the supports 1770 and 1750 zone. Let's say in case of a break these levels, the near-term focus would be likely turning towards the downside with break below 1736 to erase all the bulls and then short-term, near-term focus towards the downside for a more significant and a bigger correction of the rally from 1590 low of 15th of August. So far, bulls remain well and fully in play in the near-term chart studies, and see, of course, upside more focused as long as 1770 as initial good support stays intact. That would be all from me for today. I hope I didn't speak too fast. I got some comments and critics that I'm speaking too fast. I don't know. You have to tell me if it's like this. I got it through email, basically. Do we have any questions for today, or we covered everything? No questions. Okay, good. Then we will conclude the session because the next one is coming in Arabic language, so we're going to give some space to our colleagues to continue with the same thing now in the other language. Important releases today. Keep an eye on these figures. Of course, keep an eye on supports and resistances that we mentioned for the majors and the commodities. And wish you a nice day and a nice and relaxing weekend that is coming, of course, with a lot of luck and profits in your trading. Until Monday, when we'll be back at the same time at 7:00 GMT, I wish you good luck and a nice and relaxing weekend.